I'd like to know what you think the future of interest rates are and where I should be putting my money.
Gee, it's not every day a billionaire owner of an NBA team, Mark Cuban, asks me for advice. Now, Mark is chairman of HDNet and owner of the Dallas Mavericks. I'm sure you know that forecasting interest rates is as difficult as, say, getting a basketball team past the first round of the playoffs. At the moment, it would appear that the chances of rates climbing very much are pretty low. After all, the most recent inflation stats from the Bureau of Labor Statistics show that the core consumer price index, which excludes the volatile food and energy sectors, has barely budged in recent months and is up less than 1% for the 12 months through May. That said, I think many people see the potential for higher inflation as well as higher interest rates longer term as the economy picks up steam, as investors begin focusing less on the economy's weakness and more on the U.S.'s massive budget deficits. But this is all conjecture. The fact is that neither I nor anyone else has a crystal ball that will divine the future path of rates. Where I may be able to help, though, is by suggesting how not so much rich businessmen like you, but regular people, the non-billionaires, can deal with this uncertainty, especially when making decisions for the two areas of their finances most directly affected by interest rates, namely the cash reserves they keep for emergencies and short-term needs, and for the bond portion of their investment portfolios. Let's start with cash reserves. Since this money acts as a financial safety net, security is the foremost concern, which means the best place to keep such funds is where there's virtually no risk to principal. FDIC-insured savings accounts, money market accounts, short-term CDs, and perhaps treasury bills. For the moment at least, that means accepting a very low yield, typically about 1% or less. You can do a bit better by checking out sites that list the institutions that pay the loftiest yields. And in fact, a recent Ask the Expert column I wrote identifies a number of such sites and suggests other ways to safely boost yields. Eventually, short-term rates will start to climb, as will payouts on the most secure investments. But until that happens, the last thing someone should do is stretch too much for extra yield. Doing so means taking on more risk, and you can run into all sorts of problems, as the people who bought seemingly safe, high-yielding auction-rate securities and bank loan funds discovered when those investments ran into problems and hand investors losses. When it comes to the bond portion of one's investment portfolio, it's generally okay to take on a bit more risk, but you don't want to overdo it. Basically, bond investors face three types of threats: credit risk, or the risk that the issuer will default on the promise to make interest and principal payments; interest rate risk, or the danger that rising rates will decimate the value of a bond or bond fund; and inflation risk, the possibility that inflation will erode the value of interest payments and the face amount of the bond. Investing mostly in government bonds and high-quality corporate issues provides protection from credit risk. Sticking to bonds or bond funds with short to intermediate term maturities can limit the damage that rising interest rates can do, while still giving you a decent shot at higher long-term returns. And one can guard against inflation by owning TIPS, or Treasury Inflation Protected Securities. It's possible to create a diversified portfolio of individual bonds that will mitigate all these risks, but for people who aren't investing megabucks, it's easier to just use bond funds. And indeed, if you want, you can probably get by with just two types of funds: a total market bond fund, which gives you virtually the entire investment-grade bond market in one fund, and a TIPS fund. For the names of specific bond funds, you can go to our Money 70 list of recommended funds. And for help on putting together a well-rounded portfolio of bond funds, check out the column on creating a perfect bond portfolio. So, at the end of the day, I can't foretell where interest rates are headed any more than I can predict how teams will fare in next year's NBA playoffs. But when investing, at least, diversifying, emphasizing quality, and keeping to short to intermediate term issues can help you deal with the inherent uncertainty.